the recession has probably already started. That was the message from the Beige Book today, and corroborated by the last set of FOMC minutes.
Greetings and welcome to our Wealthion show. My name's Trey Reik of Bristol Gold Group, and we're visiting today with David Rosenberg, founder of the eponymous firm Rosenberg Research in Toronto. Over the course of Dave's career at Merrill Lynch, Gluskin Sheff, and now Rosenberg, Dave has become, to me, the dean of contrarian thinkers. In his comprehensive daily reports, Dave is a master of sniffing out weaknesses in consensus thinking and identifying hidden risks in financial markets. So, Dave, thanks for being with us today.
Pleasure to be on. Thanks for having me back.
As I was preparing for our conversation, I did think of one question that I thought I would run by you to kick things off. When was the last time you were unabashedly bullish about financial markets? Because I'm not sure I can remember.
Well, I would say that coming out of the pandemic, I wrote many reports talking about how the remote work at home theme was going to generate a whole lot of winners, and that anything that was involved in wiring up your home or deliveries to your home was going to be in a budding bull market. And actually back then I was very bullish in particular on most parts of the technology sector. So I would say that was one instant. Before then, in terms of being unabashedly bullish, you probably have to go back to when I was at Gluskin Sheff. And I think in that period, basically from 2011 through to 2016, I was bullish, and then was increasingly taking risk off the table around the Brexit file and the fiscal policy withdrawal we were seeing back then. And then, of course, we got hit with the aggressive Fed tightening in 2018, which was no walk in the park for the stock market. So if you're looking for the two previous periods, I'd say I'm notoriously late because I'm conservative in nature. I don't like to move early and get my head sliced off. So I've always basically had a philosophy to participate in as much of a bull market as possible. Nobody can time the lows or time the peaks. I'd say in that period from 2012 to 2016, call it, I caught 50 to 60% of the up move. Didn't participate in 2018, which was a horrible year for the stock market. And I'd say that, I developed this notoriety of being this perma-bear, which actually isn't true, but it's, Wall Street and the media like to apply labels to people. I guess I would just say, okay, better to be noticed than dismissed or ignored. But in my case, even when I turned bullish back in that last cycle, coming off the great financial crisis, nobody believed me. I can't tell how many emails I got saying, Rosie, you can't be serious. You're not really turning bullish. And it just reminds me of that's why they never really took John Wayne out of the Westerns and move him to romantic comedies. It's just, it doesn't work. But, before I gained fame being chief economist of Merrill Lynch Canada back in early 2000, and of course I was turning bearish right around that peak in the technology bubble, and I had a platform. But before then, I was brought into the business the day of the stock market crash in October 1987 at the Bank of Nova Scotia. And if you read our work back then, now I wasn't chief economist, but I was climbing my way up the ladder. We were bullish, and actually got out in time ahead of the 1991 recession. But then I worked at the Bank of Montreal at BMO Nesbitt Burns. And don't forget, I was a relative nobody back then. And I was working at BMO Nesbitt starting from 94 right through to 99 before I went to Merrill. And if you read the work we were producing back then, and that was, of course, much of that was the internet wave, we were bullish through most of that decade.
Mm-hmm.
But nobody would ever know that because, I was just a plain old senior economist hiding in the shadows of the chief economist at the time. So, there you have it. I am not a perma bear, although I think that was the undertone of the question. Because in our business, and actually just in life in general, there's no such thing as perma anything because nothing is permanent.
I've been doing gold.
Perma bear or perma bull is just like it's not a very well thought out label.
Right. I've been doing gold for 25 years, so I'm pretty close to your thinking on a lot of these issues. And there's a lot of things that I've been expecting for decades, which haven't happened, surprisingly, in terms of the dollar standard system, et cetera. And it does appear that finally some of these things that we've focused on for decades are starting to, actually transpire in markets. So I'm with you all the way. Specifically, your current stance on the market, I know, is sort of bent in the recession category, and you have been talking about a recession since the Fed's breakneck rate hikes in 22 and 23. And obviously, and I was in your camp 100%, no recession has yet materialized. Can you talk a little bit about why you think that's been the case and where we stand now on recession probabilities?
Right. Well, I guess you could look at 2022 and 2023 recession call as being a blown call, and that's what it was. And I was writing that what is more important in a credit-driven economy than the rate of interest? And it was a Volcker-esque tightening by Jay Powell. We've never had a tightening of that magnitude. And then you consider, the balance sheet shrinkage. We haven't had a Fed tightening cycle like that since the early 80s, where Paul Volcker gave us back-to-back recessions. We see back then there were no antidotes. And we had some powerful offsets this time around that, frankly, I didn't really see coming in the sense that, we all knew that in the beginning of 2021, we had 2 rounds of very powerful tax stimulus checks being sent out to the population, whether you had a pulse or not. And that was over $2 trillion. That was like a lottery ticket that was placed in people's accounts. $2 trillion. And the historical record and the academic research showed that households typically, when confronted with a stimulus check from Uncle Sam, they spend half and they save half. So when I did the arithmetic, there wasn't going to be enough of these excess pandemic savings to save the day from the Fed. But in fact, what happened was that all of the $2 trillion plus of stimulus checks ended up going into the economy. Which is unprecedented, and I suppose speaks to the narcissistic characteristic of society today. We went into the pandemic where at least a third of the household sector went into the crisis with insufficient savings to get through 3 months of idle employment activity. Did not have enough savings to get through 3 months of being out of work. And so my inclination was to believe that, if anything, far less than half the traditional average of those stimulus checks would be spent. But that's where I went wrong because, in my business of forecasting, your assumptions drive your conclusions. My assumption was not that, the savings rate was going to plunge from, call it 8% pre-COVID down to running close to 3%. So there was this really big shift towards consumerism. Not just the stimulus checks, but on top of that, the degree to which American households were spending more and more of their after-tax income. And the memories of COVID just faded away, or maybe people believe that, hey, if we ever get another crisis, the government will be there to bail me out. There might be that mentality. On top of all that, what happened was all the Biden stimulus, the CHIPS Act and the oxymoronic Inflation Reduction Act. So you had tax subsidies up the wazoo. You had debt moratorium for students, and you had all sorts of spending on green energy and manufacturing, construction. So that we're going to be the world's next chip-making giant. I look today and I still can't believe. Did you know this? That federal government spending today is 53% higher than it was pre-COVID in late 2019. So we had the mother of all fiscal responses that totally mitigated what the Fed did on interest rates. And it's astounding that we have 5 years in a row of the deficit to GDP ratio being in excess of 5%. Now it's closer to 7%. We didn't have 5 years of 5% deficit GDP ratios under FDR to fight the Great Depression. We've never seen this outside of a world war. We've had just the fiscal spigots have given this illusion of prosperity. And of course, government in all its forms is part of GDP. But that explains how the recession call didn't exactly work out. But we're in a different situation right now. And I think what's very dangerous is that most people in my business who made the call along with me for the recession are now in a classic case of once burnt, twice shy. And to them, it's a big deal if they take their recession odds from 25 to 40%. That's going to make it on the front page of the daily newspapers. But nobody is willing to really make a recession a base case scenario because the fear of being wrong again. But I don't let the past. I don't extrapolate the past. I try and learn from my bad calls. You learn from your mistakes. What else are mistakes good for? Than to learn from them. But the problem is that we still have a very tight Fed policy. On that point, Donald Trump is not wrong. You have a Fed funds rate that is being pinned about 125 basis points above the Fed's own estimate of where neutral is, where the economy is when it's in balance. Rates are still 125 basis points above that level, but without the fiscal stimulus. So we still have a tight Fed. There is no fiscal stimulus. There is no fiscal stimulus from this big, beautiful bill. It just basically avoids a falling off the fiscal cliff at the beginning of next year because it extends the 2017 tax cuts, mostly on the personal side, which is basically $4 trillion of those future deficits just comes from the extension. So there's no fiscal stimulus. More likely, when you look at all the tax relief measures, no tax on tips and Social Security and overtime, but you look at the other revenue-raising measures and you look at the spending restraint, which is much needed. We actually estimate that heading into next year, there's fiscal drag coming in the economy. The era of the past 5 years of fiscal stimulus is over. We're left with a tight Fed, and then Big Mama is all this trade uncertainty and tariff uncertainty. And so in answer to your question, I'll take my lead from others. We are seeing things we didn't see in 2022 and 2023. For example, we just got the Fed's Beige Book. The Fed's Beige Book told us that 75% of the U.S. economy is now either contracting or stagnating. And that's up from just about 50% 6 weeks ago. So the Beige Book itself is telling you that the recession has probably already started. That was the message from the Beige Book today, and corroborated by the the last set of FOMC minutes.
Mm-hmm.
Because when you read, when you get the FOMC minutes, the first part is about the Fed staff, the Fed economic staff, what their view is on the economy and their forecast.
Mm-hmm.
And I was struck by the fact that the Fed staffers said that the odds of a recession are now as high as their base case economic scenario, a base case scenario, by the way, which they cut. And they're saying that that cut to their growth forecast is equal in odds to an actual outright NBER defined recession. So I found that to be very interesting because we weren't really seeing that in 2022, 2023.
Mm-hmm.
We were not seeing this degree of negativity in the Beige Book back in 2022, 2023.
Mm-hmm.
And, we got the OECD forecast, not that it's gospel, but they're down to 1.5% real GDP growth for this year and 1.6% for next year. Now, these are averages. But when you go back all the way to 1948, what you find, because that is otherwise known as stall speed. When you get to stall speed, 2 years in a row of call it 1.5% real GDP growth, embedded in that 2-year time frame, embedded in that is a recession back to 1948, 100% of the time. 100% of the time. So, the no such thing as a sure thing. But I think that the base case scenario is a recession. I think it could be starting now. I know people are aghast because how could you say that when the Atlanta Fed nowcast model is 4.6% for the second quarter? But that's primarily because imports fell out of bed. We had a record plunge in imports because of all the volatility around the trade data. And so you can create, once again, this illusion of prosperity through GDP because imports are a subtraction. But when I'm looking at, the monthly data flow, and I'm seeing negative single-family housing starts, negative building permits, negative non-residential construction, negative prints on core CapEx shipments, negative retail sales volumes, back-to-back declines in auto sales. So everybody is saying, well, it's just the soft data. It's not the hard data. And we're going to wait for the soft data to morph into the hard data. And what I'm saying is that the soft data that we've been seeing, as in the survey data, which tell us about behavior, they're not hard dollars, but it's starting to morph into the hard data. I'm waiting for the day when Jay Powell will no longer say, well, we're waiting for the soft data to move into the hard data. It's happening. Mm-hmm. And on top of that, I would say, basically, the Fed's been doing this Beige Book since 1970. And they send out their agents into the field to speak to industry contacts across the entire economy, across industry and across regions. It is just a sensational amount of information. We get it every 6 weeks. Mm-hmm. Well, I want to ask, my hope is that someday somebody in the press at the post-meeting press conferences, somebody asked Jay Powell, why do you still do the Beige Book? Why do you bother doing the Beige Book when you don't even listen to it? Mm-hmm. Or why are you employing these Fed staffers who are telling you that the odds of recession are 50% and you don't listen to them? Mm-hmm. Maybe I'm being too harsh. Maybe it's just that they're so consumed with their credibility and reputation, having missed transitory. Powell is on his way out May of next year. Doesn't want to be remembered as Arthur Burns. Arthur Burns gets tarred and feathered, I think, rather unfairly. But, that's the moniker on Wall Street once again. You don't want to be Arthur Burns if you're a central bank chairman, that's for sure. You want to be Paul Volcker. But the inflation concerns, the uncertainty around inflation that's dominating the Fed right now. But I would say that that the economy is losing momentum at a rapid clip. And what amazes me the most is how much in denial risk-on investors are right now, whether you're in the credit market or the equity market.
You've done some work.
There's no recession risk priced in at all.
Right. You've done some work on the soft data, which suggests GDP is actually negative at this point. Can you talk a little bit about that?
Yeah, so we modeled out the soft data, all the survey data. There's a plethora across the consumer and across the business sector, and we modeled it out. And it's telling us actually that what's it consistent with? It's consistent with minus 1.3% real GDP growth. We actually run a machine learning model on the Beige Book, and it is telling us that second quarter is flat to negative. Now you're going to come back and say, but what's with the Atlanta Fed? Well, like I said before, it's really rather artificial. It's basically the 4.6 from the Atlanta Fed, and we'll see what happens to that number, is not a reflection of strength. It's a reflection of sagging imports at an unprecedented rate after surging at an unprecedented rate. So that's all the Atlanta Fed is telling us right now. But the monthly pattern of the data is decaying. And the soft data always leads the hard data. The soft data is all behavioral. It's telling you about behavioral shifts. It's not much different than looking at company reports. I mean, and people push back on this view, to which I say, did you notice what Dollar Tree and Dollar General had to say this week? That the reason why their numbers are up and their visits are up is because the wealthy are now shopping at discount stores in droves because they're starting to feel the stress as well. And so, so there you have it. That is the sort of things as an economist you want to look for. You don't want to forecast a recession once it's started. Of course, when you forecast a recession, you want to get it right. No guarantees that that's always going to happen. But you do your best and you read the tea leaves. There is a visible shift underway in the consumer and business sector. And I could tell you that, the canary in the coal mine was out there for all to see late last year when Jay Powell, after one of his meetings, compared the current situation of the Fed moving to the sidelines to say basically when you're in a dark room with furniture, what do? You stand still. And that's this elevated level of uncertainty and confusion we have in our hands right now. In that Beige Book, it's not that big a report. We had something like 112 citations of tariffs, 80 mentions of the word uncertain or uncertainty. That's absolutely incredible. In the past 6 weeks, these last two Beige Books, we have never ever seen the word uncertainty show up that much, let alone the word tariffs. But the word uncertainty, and of course they're joined at the hip, although there's other uncertainty right now. There's also fiscal policy uncertainty. But the trade uncertainty, the tariff uncertainty, make policy up on the fly. That is really unnerving the private sector. Now, the private sector in the real economy, not the individual investor in the stock market who's whistling past the graveyard, in my opinion. When you have a situation where uncertainty is elevated, and we're talking about most measures of uncertainty, and there are historical measures, we're talking about at least a 3 standard deviation event taking place. And what happens is you go into the Jay Powell dark room, and you're seeing that. Now you're seeing the savings rate in the household sector starting to go up. Consumer spending is not just slowing, but as we're seeing in the retail sales data and in the auto sales data the past couple of months, they're starting to actually contract. And business spending, as far as CapEx, companies are just sitting on their hands. Who's going to be spending money in this environment? The answer is nobody. And then in the housing market, you've got affordability completely out of control. Affordability is almost a 2 standard deviation event. You got sky high prices. Now they're starting to correct, probably more to go. But you still have these punishingly high 7% mortgage rates. The qualifying income for a first-time buyer to purchase a home today, a medium-priced home, the qualifying income is $100,000.
Mm-hmm.
But the median income of the first-time buyer is only $70,000. That's a bit of a problem, don't you think? That is out of balance. So, you're not going to be getting any lift out of the housing sector. And then, as far as the foreign sector, as far as exports are concerned, the world is flat. For sure, Europe's going to be going through this fiscal boom on defense and infrastructure, but that's got a long gestation period. So for the life of me, I cannot see, maybe you can help me, I cannot see outside of data centers, outside of AI, and there's lots of spending on that, but outside of that, I do not see where the vitality of the U.S. economy in the aggregate is right now.
Right.
And that was ratified in the Beige Book, because they were loud and clear. That Beige Book, that was my opinion, that was the recessionary stamp that we got on the Beige Book. That, by the way, was not as emphatic in 2022 and 2023. This was emphatic. And I would suggest ignore it at your peril.
So one of our colleagues, who I'm sure you've followed, Danielle DiMartino Booth, has spent a lot of time on labor figures. And one of her contentions, I guess, is that the labor markets are much weaker than what the data demonstrate. And I think the quarterly census on employment and wages was due today. It should be out today, tomorrow, that type of thing. But what do you make of the labor market? Is it as strong as the Fed says, or has there been really big misses there with the birth death model and all that type of stuff?
Yeah, well, the birth death model has been accounting for about half that payroll growth.
Mm-hmm.
It tends to exaggerate the increases as you move through the business cycle, then exaggerates the declines in the recession. But that you're 100% right. There's two numbers. There's the actual survey, and then there's the skew from the birth death model, which has continued to add jobs.
Mm-hmm. That's
why the QCW data actually did come out, and it shows that year over year. Now it goes to December. It shows that year over year, payroll growth was really 0.8% year over year. 0.8.
Mm-hmm.
0.8.
Mm-hmm.
That's a boom. Okay. Non-farm payrolls, what we trade off of on those non-farm Fridays, that's up 1.3.
Mm-hmm.
And so we'll get probably another big downward revision to payrolls. But, you have a 0.5% difference, 1.3 versus 0.8. 0.5% difference on 130 million workforce. So you're talking about payrolls, and Danielle is right, 100% right, that employment is being overstated. The numbers that traders trade off of, they're fictitious.
Mm-hmm.
And that's why the revisions are so wild.
Mm-hmm.
And I think in the past year, 3/4 of the time, the revisions were to the downside. So, you're trading off of a certain number on non-farm Friday, and you get whipsawed, and you think you're wrong, and you're painfully in the red on your books, only to find out the next month when it's too late that actually, with the revision, you were right.
Mm-hmm.
The error term, and it's because the sampling is a lot lower than it used to be before COVID, the error term is extremely wide. But let's just say that a 0.5% difference in the growth rate between QCEW and non-farm payrolls, that's equivalent to 800,000 jobs being overstated. That is not insignificant. I think the labor market is cooling. It's not collapsing, but it's cooling off substantially. We saw that with the ADP number. And the ADP number, the key feature there was that you had a decline in small business employment for the first time in a few years. And small businesses have a front row seat to the economic game. The small business sector is in the weeds.
Mm-hmm.
They have a front window on the economy, and that's a leading indicator. So the key was in May in the ADP was that negative print on small business. That's very important because they lead the big guys. What else? Well, we got the JOLTS data. And what I want to say about the JOLTS data is that when you look at the numbers that really matter, and it's not the job openings, it's actual hires and actual fires. Because you could post a job on Indeed 1 month, take it off the next month, but hires and fires are actual decisions. A lot of the time, companies will post a job just to test the waters. It's not really a true measure of labor demand, although it's the number that Jay Powell pays most close attention to, which baffles me. But it's the actual hires and fires in the JOLTS data that matter. And in 3 of the past 4 months, the number of fires, the number of layoffs has outstripped the number of new hires. So you're seeing, once again, in the labor market, there is it's not collapsing, but there is a decay. There is a decay. And just keep in mind that depending on what the labor force does, and you are seeing out of the initial jobless claims numbers, this massive and rising backlog of continuing claims. It's taking longer and longer for people who are out of work to find a job. And you see that in some of the soft surveys, like in the Conference Board's Consumer Confidence Survey. They asked the question about jobs being hard to get or jobs being plentiful. And those numbers are not moving in a very pro-growth fashion. So the labor market is cooling. The question is, at what point will we actually go from strong to weak to that negative? That'll be the key in terms of bringing forward those rate cut expectations out of the Fed and provide some life to the maligned Treasury market. It's a waiting game right now. So we got to wait for employment to start to show up. As much as it's a lagging indicator, nobody will believe that we're in a recession until payrolls start to decline. Of course, even though we might have had a quarter decline in real GDP in 2022, there wasn't 2. It got revised away. There was 1 negative quarter. We never really got the employment contraction. That will catch people by surprise. And the unemployment rate going to 4.5% or higher. We're at 4.2 right now. But we cross above 4.4. That's the peak forecast this year by the Fed in the latest dot plots. Those are the sorts of things we have to see, because the Fed is so consumed with inflation concerns from the tariffs that we're going to have a real break in the jobs data to get them to rekindle the rate cutting program that they abandoned late last year.
So you bring up the Fed. I'm going to hit you with a bench clearing statement or question. On a scale of 1 to 10, what's your confidence in the Powell Fed?
Not much. I mean, there's only 2 people in the Fed that speak my language, and it's Goolsbee and it's Waller. And that's pretty well about it. I never really liked the fact that, Jay Powell will come up with a statistic to justify his stance, like the supercore. The supercore, remember the supercore, the services, X energy, X housing. So to justify his overt tightening stance, it was the core services CPI. The fact that it printed negative in April, that hasn't caused him to sound any less hawkish than he has. Oh, so I guess maybe he's not looking at it anymore. Now he's got a new GDP number, right? He's got a new GDP number. And what it is, it's consumer spending and business spending added together, as if that's the entire economy. It's a reasonably big chunk of the economy, obviously, but there's another, call it 20% out there. So he just says, well, the economy is great because add up consumers, add up business. But Mr. Powell, are you telling us we should ignore housing? We should ignore housing? We should ignore net exports? Really? we should exclude government. We should exclude inventory swings. I just, but it's just basically come up with something that will justify our current stance, and I'm just shaking my head. So I'm also concerned that the Fed is fighting the last war in the sense that they are consumed with the damage to their credibility. There's no evidence right now that there's any damage to their credibility, but, they talk transitory. I mean, the question is, 18 months wasn't 18 years. It wasn't the 1970s like everybody thought, but nor was it, 3 months. It was 18 months, of inflation going from basically zero all the way up to, call it roughly 9%, only to come right back down again. So the Fed corrected that policy error, but they're so gripped with fear about their credibility and the timing of Jay Powell's departure in May. Mm-hmm. And I think that he would rather go out being compared to Volcker than being compared to, say, Arthur Burns. So they're being deliberately tight. Mm-hmm. And so I just think that there's just too much of that, too much of weight being put on the fact that they blew the call on inflation. Mm-hmm. I guess I just have a philosophical difference. I am not factoring in the fact that we didn't have recession in 2022, 2023, because I understand the reasons why we didn't get the recession. It's not stopping me from calling for recession right now under different circumstances. Mm-hmm. So, to extrapolate, what happened a few years ago into the future, I think is a pretty dangerous game. And I think that's what the Fed is doing. Mm-hmm. By the time all these coincident indicators and lagging indicators the Fed focuses on, play catch down to what the leading indicators have been saying for some time, it's too late. And then they'll be scrambling. So that's one thing that has me unnerved, is that this has not been, this Powell Fed, certainly unlike the Greenspan Fed, is not forward-looking. They focus strictly on contemporaneous or lagging indicators. Mm-hmm. They have for years. They seem to get away with it because Jay Powell, if you speak to most people on Wall Street, they love Powell a lot more than Donald Trump does. Mm-hmm. And everybody is fine. When you go on CNBC or you look at Fox News or Bloomberg TV, everybody is just rolling out the red carpet mm-hmm. for the Fed. I have to say I am more critical. I will always be critical of a Fed that does not listen to its own Beige Book mm-hmm. and does not listen to its own economic staff. That's a situation that troubles me.
Yeah. I think looking back, you probably agree that the decision to pump the $120 billion of QE per month throughout 2021 with GDP at 6% and CPI already on the way from 5 to 7 and unemployment down from 14 to 6 will go down as one of the most damaging Fed policy errors of all time. Do you agree?
Yeah, I would agree. And look, Bernanke got the ball rolling on QE, say back in 09, but we came off a mega crisis of 1930s proportions, and then we had a very abnormal recovery, and still with an output gap, inflation below target. That was a frustrating period, different concern that the Fed has on its hands today, but we mm-hmm. weren't fighting a tariff and trade war. Mm. So we also had, remember, after Barack Obama's first 2 years, where he only accomplished Obamacare, well, then the Tea Party took over and we had tremendous fiscal restraint. People tend to forget that we went in a matter of like a half a decade from, about a 10% deficit GDP ratio mm-hmm. in like 2010 all the way down to 3%. It can be done, but you need a Congress that's tough on fiscal policy.
What do you
So,
expect
I was just saying the point. As I digress. I just want to get the point across that QE, and most market participants won't like this, but QE could be justified back then, based on just how weak the economy was, below target inflation and fiscal drag. Well, we don't have any of that just yet, right? So, but I would tend to agree with you. The whole thing, taking rates to negative in real terms and leaving them there. I mean, remember that Pfizer Monday was November of 2020, right? We had Pfizer Monday, the economy reopened, and then we had these gobs of fiscal stimulus. Like, in retrospect, it was foolhardy not to think there was not going to be an inflation response. The beauty of 2020 hindsight. You had impaired supply chains globally. You had mountains of money from the Fed, and the Fed basically accommodating fiscal largesse at a pace and a level that we just basically have not seen before. I mean, think about it. The fiscal policy made a mockery out of the New Deal. Last I saw, though, we weren't fighting the Great Depression. So anyway, yeah, that was the QE, the rate cuts, the excess of stimulus got us into a lot of hot water, and now we're paying for it again because the Fed is nervous they're going to make a mistake again if they cut rates. Keep in mind, another key difference is we came off of zero in that tightening cycle. We were, call it at that point 250 basis points below neutral. Now we're 125 basis points above neutral. So just looking at the state of affairs today, policy is tight. And guess what? You're seeing it in the most credit-sensitive sectors. Because you could look at the stock market and say, well, look what's happening in the stock market. We're closing in on the highs. The home builders are still stuck in a fundamental bear market. And the housing market is still extremely weak. And that traditionally has been a leading indicator for the overall economy because of all the powerful multiplier impacts that residential real estate exerts right across both the goods sector and the services sector. Something else that people aren't talking about, we're focused on data centers, focused on the AI craze, from a bullish standpoint, but the housing market is massive. It might only be, call it 3% of GDP, but it packs a powerful punch for the rest of the economy, and it already is in a recession of its own.
So switching gears a bit to financial markets, I've heard what you said recently about treasuries and the proposition they currently present, but can you give us an outline of your view of the comparative valuation of equities and bonds and your thoughts on treasuries from this point forward?